Meantime, we spent a lot of time this year talking about the rapidly shrinking euro and whether the European debt crisis could eventually even banish that currency altogether. But take a look at this chart. Since hitting a three-year low back in June, the euro is actually up nearly 6% against the US dollar. Is this a blip? Is this the start of a new trend? What's at work? Well, Sebastien Galy is the senior currency strategist at one of the top 10 foreign exchange houses globally. That's BNP Paribas. And he joins me now from their offices here in New York. So, Sebastien, weigh in here. What's behind the run-up? I thought we were talking parity just a few weeks back.
Oh, we haven't forgot that one. What we're going through right now is essentially a stabilization of the credit market in Europe. I think you had the U.S. stress test, which worked and helped basically stabilize the banking system a while ago in the U.S. We're going through the same phase in Europe, and that's appealing to many investors. So what's happening is first, initially, people were cutting their short euro position because they were afraid, so euro dollar started to rise. Secondly, you start to see some interest in basically compressing the yield, for example, of the Spanish 10-year versus the equivalent in Germany. And that's very attractive, it's very wide, and it's a fairly safe bet. And I think everybody's waiting for some clarity regarding the European stress test.
Well, Sebastien, yesterday we got some detail on a little bit of detail on how those stress tests are going to be structured, and there's some controversy as to how the cost of Greek default is actually being accounted for, and whether the test is truly a worst case scenario here. So, are you seeing any more interest in shorting the euro at this point?
No, I think people are waiting basically to pressure it higher. The question of the stress test is not really necessarily the default rates. It's mostly if you look at the sovereign side versus, let's say, commercial real estate, how much you stress one relative to the other. And what you'll figure out is if I'm given a number, I can always multiply it by 4 or 5, so it's not that relevant. All that matters is the relative call on one asset class versus the other. So I think if you look at the default rate that's been assumed for Greece versus, let's say, Spain or even France, it actually makes some sense at this point in time. People are not shorting the euro. Actually, they're looking for a break higher at this point in time. We've tried to break 126.85. We have broken it, but equity markets right now are tearing off a little bit ahead of the earnings release next week for especially the banking side.
What's behind recent yen strength? Is it because of interest in sort of flight to safety purchases here, or is there something more at work?
There are several mechanisms. One is there's only 2 currencies in the world that you want to buy when you're afraid. That's the Japanese yen and the Swiss franc. Second one is the Chinese have been buying government bonds in Japan. That's been a bit of a surprise, and that's actually pressuring the currency higher. Third mechanism is the corporates in Japan are actually doing very well, and because of hedging needs, they are actually selling dollar yen in a consistent fashion and lowering what we call their break-even, so the level at which they will basically sell dollar yen from 90 to 89 to down the right to 88. So they've been pressuring the currency also lower on that one. And at the same time, the last one is the Japanese are investing in the U.S. They have a mass position in U.S. Treasuries. The curve in the U.S. is very, very flat, so it's less appealing.
You say that there's a lot of sort of technical trading happening around the U.S. dollar right now.
Yes, I mean, in the sense that if you look particularly at euro dollar, we just want to go for the uptrend. We're looking for any techie breaks, and we've achieved one. We don't have enough momentum at this point in time. Once the stress test, the details are going to come out today. Probably what's going to happen is there's going to be a rush towards Europe to pressure these peripheral bonds back towards the levels or closer to the levels that we see in Germany, and that should pressure the currency much higher.
And the buying of these commodity nations, the Australias and the Canadians, is that going to hold in?
Short term, yes. And when we're trigger happy and we want to take a little bit of risk, we're basically going for Aussie commodity currency. And the problem is going to happen when we get the Chinese data coming in next week, and that's going to be a bit of a surprise.
All right, Sebastien, thank you for taking us around the world in just a few minutes there.